Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Turkey dominates financial markets the world over. The country's currency, the lira, continues to slump to new lows. It is now down over 40% year to date and probably 50% in the past 12 months. Markets in US, Europe and Asia have all fallen on the back of the free fall in the Turkish lira. Most Asian markets today ended 1.5 to 2.5% lower. Emerging market currencies like the Indonesian rupiah and the Indian rupee have fallen over 1%. So how did Turkey get here? Despite being one of the fastest growing economies in the world, the problem is that expansion during the periods 2008 to 2014 was fueled largely by foreign currency that they got during the cheap money years from 2008 to 2013, when central banks around the world were pumping money to stimulate their economies following the global financial crisis. Turkish banks and companies were raking up debt denominated in US dollars. That borrowing, which fueled consumption and spending, resulted in Turkey running deficits, both in its fiscal and in its current account. The current account deficit now stands at 5%. It also led to high inflation. Today, the country's inflation is at 16%. That's the July number. Yet, the country's central bank did not increase rates at its meeting on July 24th. This, in turn, is because the country's president, Erdogan, has pressured the central bank to maintain low interest rates in the interest of growth. In fact, after Erdogan's recent re-election, he has appointed his son-in-law as the finance minister and centralized all monetary and fiscal powers in his own hands. Separately, the United States on Friday doubled its tariffs on steel and aluminum imports from Turkey. This move has come in retaliation to the arrest of an American pastor, Andrew Berzin. Well, Erdogan's government is accusing the pastor of being part of a failed coup in 2016. The United States has rejected the charge. Welcome to our special show, The Turkish Trouble. I'm Latha Venkatesh, and with me are a panel of experts to tell us how far this crisis can go. We are joined by Nick Parsons, Head of Research and Strategy at Thomas Lloyd, Andrew Kenningham, Chief Global Economist at Capital Economics, Piotr Mattis from Rabobank, and Manish Wadawan, Head of Global Markets at HSBC India. Gentlemen, thank you very much for joining me. Well, Nick, let me start with you. What is your sense from a market perspective? Are you surprised at the reaction of all currency and equity markets to what should have been a localized Turkish problem?
Well, good afternoon from London, first of all. I'm not surprised. I think what we have to look at here is the scale of the reaction. And for all that we see currencies such as the Indian rupee with headlines that says it's an all-time record low, the scale of the movements has thus far been relatively limited.
Okay.
Now, the Indian rupee has moved barely 1%, well, 1.25% today,
okay,
on a day when the Turkish lira has gone 7%. If we look over the course of the last month, the Turkish lira has gone 45%, and India has barely moved 2%.
Yes.
So really, it is a very, very limited contagion. It's not because people expect that India is now going to be worse off as a direct result.
Yeah.
Rather, that they suspect indirectly that others might think it's going to be. So really what we've got here is a preemptive liquidation rather than something which is panic and specifically driven. So really, this is a preemptive move to preserve capital just in case things get wrong, rather than something which is a sign of specific country-led weakness.
Okay. Well, what you're saying seems to suggest that peace will return quickly. But I'll come back to you for what we should expect hereafter from emerging markets in general and India in particular. But let me get Andrew into the conversation. Andrew, how would you look at Turkey reacting? Can this implode and this crisis go on? Already some steps have been announced in terms of reserve requirements. Do you think Turkey can stem this problem with some huge interest rate hikes or other such measures? Is this going to be just a week's problem at best?
Well, I think they could stem the problem if they were to take the kind of actions that are needed, which are not just very substantial interest rate hikes, but also something to re-establish the independence and credibility of the central bank, and probably now something on the fiscal side. And the problem is, as you said in your introduction, that the president seems to be very reluctant, is completely opposed to raising interest rates, and sees this whole thing as some kind of conspiracy from outside rather than something caused by Turkish economic policy, which is in fact the heart of the problem. So it could be solved, but I don't think it's going to be. I think we're going to see things get worse before they get better.
Okay. In that case, how are you? How do you see these reactions panning out? Even assuming the lira falls further, do you see much more trouble for the euro and much more strength for the US dollar, Andrew?
No, I think that the reaction we've seen is a sort of knee-jerk contagion response to what came as a bit of a surprise. Not the fact that Turkey was in trouble, but the extent of the fall in the lira and the extent to which the president was willing to confront markets and refuse to do what was required. That was a surprise. Then you get these market moves, some of which have been very big. The South African rand is down 10% or so over the last couple of working days. But once the markets become used to the fact that Turkey's going through a prolonged crisis, I think these reactions will fade and we'll see some rebound in some cases. Most likely the rand, for example, will come back.
Let me get Mattis into the argument as well. Mattis of Rabobank. What's your sense? Should we expect further problems for the lira itself? And more importantly, the contagion in, contagion is a strong word, the impact on other currencies like the rand, and more importantly, emerging Asian currencies like the rupiah and the rupee. Do you see more impact in these countries and in these currencies?
Well, the outlook for the lira is definitely looking bleak. It's absolutely shocking that despite the ongoing sell-off in the currency, the central bank remains reluctant to use interest rates to defend the currency. They made policy mistake last month when they refrained from raising interest rate against myself and other market watchers' expectations for a hike. Since then, the currency extended its losses, and yes, they revealed some measures earlier today, but those measures are unlikely to prove sufficient to provide the lira with a long-term respite. So a rate hike is still required, but and other steps that Turkey urgently needs to take. One of them is definitely an attempt to ease diplomatic tension with the US, and we are also waiting for Finance Minister Al-Bayrak to reveal more concrete details, how he intends to strengthen public finances and how he intends to withdraw the substantial fiscal stimulus implemented over the past 2 years or so. Okay.
Well, even as Al-Bayrak and Erdogan, come to terms with the reality, do you think the euro has fallen enough, Piotr Mattis? After all, there are only 3 banks that are exposed. So is the euro weakness and the dollar strength over and done with?
Well, we've held a relatively bearish view on euro-dollar over the past few months, almost since the very beginning of this year. And this view was based on the notion that the interest rate differentials will continue to widen with the Fed raising interest rates at the time when other major central banks, including the ECB, are reluctant to do so. So we've had a relatively bullish view on the dollar against both G10 and various EM currencies for at least 6 or 7 months or so. So that said, speaking specifically about the lira, I have to admit that the scale of the sell-off significantly exceeded my expectations. I've been hoping that after crucial presidential and general elections held a few months ago, and the Erdogan administration will adopt a more rational approach, and they will focus on implementing much needed structural reforms that they will allow the central bank to do what is necessary, that the central bank will be able to regain its credibility. But it hasn't happened, so my cautious optimism has been completely tarnished.
Okay. That said, it's the reaction to the euro that is more important, because that's how it is getting transmitted. A euro weakness leading to the DXY crossing the 96.49 at one point in time, now 96.25 thereabouts. Nick Parsons, what's your sense? Has the euro fallen enough, and therefore the dollar has strengthened enough, or do you think the DXY can even go beyond 96.5?
Well, it's a very good point you raised. Let's remember that the DXY comprises the euro comprises 57% of the DXY index. So really, if the euro is weak, then the DXY is by default going to be strong. The European bank exposure, if you look at BIS numbers, is estimated in total around 194 billion US dollars. So we've got potentially here enough of a concern to keep the euro pressured against a background where interest rate differentials are only going to widen. Now, the big question as to whether the euro is going to weaken further really depends on any hints from the Fed as to whether they will or will not be raising rates at their September meeting. Thus far, the volatility in asset markets globally has not prevented them from this 1 quarter per quarter pace of tightening. But if we were to get to the point in September where higher asset market volatility were indeed to impact upon their monetary policy making, then that might be the point at which the dollar's strength comes to an end. But as long as the markets are still telling you there's a 90% probability of a September hike, then the dollar is still going to remain the most favored amongst the major currencies.
Well, actually, in the recent past, and I'm taking recent as much as 5 years, the dollar has gone above, the DXY that is, has gone above 96 only on 2 occasions during the taper tantrum time, 2013, and I think 2016, when there was this big fear of Chinese devaluation. Otherwise, 96 has been quite a high for the dollar. What's your sense, Nick? Does it get even worse? Because that seems to be the conduit of currency instability in Asia.
I think the dollar strength can continue unless and until President Trump signals more actively his displeasure at it. Because he made a couple of tweets about 3 weeks ago where he complained about dollar strength, but thus far he hasn't followed through on that. Now, if we start to hear much more vocal complaints from the president himself about the impact of a strong dollar on growth, then I think we'd have to reevaluate this possibility of continued dollar strength. And I think that's the thing we need to look at from here, is what the U.S. administration's take on the dollar strength is going to be here.
Okay, then how would you advise funds who may be asking you about whether this is a good time to buy Asian equities? There seems to be a fairly attractive fall, in India at least, from all-time highs. The Sensex and the Nifty have receded by about 2 or 3%. Would these dips be taken to be attractive? Because ultimately there is no causal link between Turkey's macros and India's macros.
Sorry, I wasn't sure to whom you were asking the question. I think that there's we have to face the possibility of a more extended pullback in global equity markets than just 2 or 3%. And I don't think that we've got a compelling valuation basis upon which to say that, after the decline of the last 10 days or so, this is time conclusively to be buying in. I don't think on valuation grounds we've got to those levels of attractiveness yet, no.
Oh, okay. So you, on what basis do you think that there can be more of a fall in global equity markets? I mean, today, almost any Asian market you picked has fallen between 1.5% and 2.5%. The worst falls coming in China, which is the other target for US tariffs. So you're saying that we should be prepared for a longer, a period of equity market falls?
Yes, that's exactly what I'm saying.
Why would you say that, though?
so far we're measuring the decline in single-digit percentages and a matter of just a few days. And I think this has got the potential to see a lot of major indices moving to and through for example, their 200-day moving averages. If we look at the Nifty 50, that would take us down to 10,600, which is another 5% below current levels. That's where the 200-day average sits. And when we talk about valuations, when we talk about momentum, when we talk about attractive entry points, I think that's the sort of level that we've got to have in mind. The fact that it's 200 points off the all-time high does not yet represent a dip, which it is compelling to buy.
Okay, now this is an interesting point that you are making, that you see further falls across equity markets, including in Asia and in India. I would want to know why. We have to take a very quick break, but we are continuing to discuss the Turkish lira's fall and its impact on global equity and currency markets. We've been speaking with Nick Parsons, Head of Research and Strategy at Thomas Lloyd, Andrew Kenningham, Chief Global Economist at Capital Economics, Peter Mattis from Rabobank, and Manish Wadhawan, Head Global Markets at HSBC India. Very quickly, Nick, if you can tell us, why do you expect global markets to remain under pressure?
I expect them to remain under pressure as long as volatility and uncertainty over the near-term economic outlook continue to eat away at investors' nerves. I also expect them to remain under pressure because if you look in developed markets, year-to-date returns are roughly zero. And if we look in the emerging market complex, here we are with the Nifty at 11,300 at the moment. It was 10,500 at the start of this year. So we've got a 7.5% gain for local investors against the current backdrop of that rising volatility and that rising uncertainty. Why wouldn't you cash in some of the chips at these levels?
Okay. Would you agree, Andrew, that there is likely to be a slightly long-drawn fall in equity markets?
Yeah, we are forecasting a fall in equity markets. I mean, obviously the massive uncertainty, nobody can be sure what exactly will happen. But we think overall there are some significant headwinds for equities, particularly rising interest rates in the US, and there are some additional headwinds for emerging markets coming from the fact that the strong dollar is usually a negative for most EMs or many EMs. Weaker commodity prices aren't helping, and we also see China slowing, which is going to have an impact in emerging Asia. Plus, on top of that, you've got the protectionist rhetoric and the tariffs that have been imposed. So we think EM equities are likely to soften somewhat over the rest of this year.
And you're rooting for a continued strength of the DXY?
Yeah, we think as the Fed is likely to continue raising interest rates. I don't think President Trump will intervene necessarily, and even if he were to talk about the dollar being too strong, I don't think that would affect what the Fed is going to do. So as long as we have this interest rate differential widening with the Eurozone, which has been a bit weaker than expected recently, then yes, I think the dollar will probably be under continued upward strength. We actually think that might go into reverse later next year because we think the US growth period is likely to slow, but that's probably 6 to 12 months away.
Oh, okay. Well, now we come to perhaps what is most important for our viewers, what happens to the rupee. Manish Wadhawan, thank you very much for your patience. What's the thinking at HSBC India? Do you expect that we go now from going to further weakness on the currency? Today itself, was it the absence of the Reserve Bank that triggered the selling, or was it some other factor?
Hey, Latha, I think I heard all your other panelists. I would like to give some kind of a view in terms of what the domestic banks are feeling here and what's on the ground. First of all, I think rupee depreciation is in line with what has been happening across all the emerging market currencies. We are not in the worst category of Turkish lira or ZAR, or which is depreciated by something like 45%, or we are not in the good category of around 4-5%.
No, Manish,
I would say, yeah.
Manish, I mean, I completely take your point that this depreciation is most helpful for the Indian economy. I think the rupee had an unusually strong run, which actually started hurting both companies competing with imports and with some Indian exporters as well. But I'm not here debating what is good and bad. I'm just asking you if we are going to see the 69.93 on the rupee go on to 70 plus, 70 and a half plus, or 71.
Sure. Okay, I'll have to give you a brief background to it. In the last 2 weeks or so, we have seen a lot of stability in rupee. In fact, we saw a lot of FPI inflows through the debt route also, which was, I think, around $900 million. And we had some large inflows into the country through the FDI route. Today was one of the days which I think we saw a reversal, which was emanating from the offshore markets, putting the pressure on rupee. Now, coming back to what is going to happen in the next 1 or 2 days, definitely, can it cross 70? Yes, it can cross 70. I don't have any doubts about it. It's quite possible with oil remaining here. You see one more, pressure on the EM world, and you will see this move happening. But I would also like to point out that it would not, unshackle the equity market or the bond markets here. I don't see that happening unless and until you see a depreciation beyond 5% more from here. That could definitely trigger some kind of a worrying signs in Indian markets.
Okay. Today actually we've had a very good macroeconomic number coming in. The July inflation coming in at 4.17 against expectations of 4.5, and widespread expectations now that the August inflation number is going to be under 4%. Given this surprisingly good number, would you not expect a quick turnaround in both the currency and the bonds, Manish?
Bonds can remain stable with this data, and it is definitely positive for bond markets. But currency, I think it's more of, it will get determined by prices of oil and the USD strength versus the other currency pairs, as I think our panelists are also pointing it out. So maybe tomorrow you might see a thing, but, as and when some kind of a news happens, we are with the trend only, and that should prevail.
Okay. Nick Parsons, before I let you go, what would your guess be on the rupee? 70 is actually welcome to most exporters and to those who are competing with imports. It's economically at this point in time probably a strength. It's only the rapidity of the fall that will scare people, not the fall itself. But nevertheless, not taking the good and the bad, where is the direction? What do you see as the range of the currency?
Well, I see the range for the rupee from 67 to 72. I think we're going to test the high side of that range over the coming weeks. But when we settle down, we are going to be back looking at economic fundamentals. We are going to be looking increasingly at governance. And that's very important. Governance is one of the things that's undermined the Turkish lira, but it's certainly a positive factor for the Indian rupee. We've got an independent central bank. We have fiscal and monetary policy which is designed with long-term stability in mind. We've got foreign direct inflows. We've got increased overseas investment. These are not things which, taken together, would suggest a permanent depreciation of the currency. So within the EM universe, I think we could expect some relative outperformance from those countries and currencies such as India, where we've got the green light on governance. And I think that's one of the things that's really going to be a support for the currency over the months ahead. Okay,
we're running out of time. Andrew, last thoughts. If you're looking at the EM currencies, what would you say about Indian equity, or more importantly, Indian currency markets?
Well, yeah, we're actually fairly bullish about the Indian economy as a whole. We think it is a sort of bright spot in the emerging world. It doesn't have the same links with China that other parts of emerging Asia do. It has very strong underlying growth that's been helped by some modest sort of structural reforms by this current government. We also think there'll be one more rate hike in this cycle, and that will probably push the rupee up. So our end-year forecast is actually 65 to the dollar.
Oh, that's very strong. Perhaps too strong for many people who are listening to the show. A final word from you, Mattis. Your guess on the euro dollar, 114, where does it go?
Well, looking from the perspective of technical analysis, so we've clearly broken well below important previous lows set in May and in June. So we have next key technical support area around 1.1187. So this is our next target, and as I already said, we've been relatively bearish on euro dollar for a while. And just briefly to point out that dollar yuan is a very important indicator of market sentiment and sentiment towards emerging markets. So dollar yen is also setting the tone. All eyes on the lira, but watch closely dollar yen. So if the dollar yen continues to rise, that would be a negative signal for various emerging markets.
Oh, that's very important for us, certainly. Thank you very much for pointing that, Peter Mattis, Andrew, Nick Parsons, and Manish Badawan. Thank you very much for joining us on this special show.